Something like that.
Yeah, then you need to open the internet browser, so Chrome or whatever you use. And then when you go into something, it should prompt you to enter it. So just try Beast or XTB.
Okay.
You need to.
No?
What's the address you need to go to for the Wi-Fi to type in?
I'll bring it there.
Yeah, it's XL or and then I'll tell you. You need to type it in. You should have that. Just wait a second for the Wi-Fi. Has anyone managed to log on to the Wi-Fi? No. I think you need to join that X network and then you need to type in something in the browsers like WL or we'll just find out exactly what it is and then you enter the username and the password on there. Little slip. I'll just find out, sorry, one second. Yeah.
Sorry, I'm just going to. I'll give that back to you in 2 seconds.
Do you want to type it into a web browser?
That would be a little bit easier, yeah. I didn't want to mess up your stuff.
Yeah, just type it in there if you want. Cool. It's the mouse, but it's changes it up.
What, so if I can just, oh yeah, okay, so that'll work.
Yeah, that's it.
Just make sure that the laptop is charged.
Yeah. Well, Eric was just saying he's worried there's an update scheduled for about 30 minutes time.
Oh no.
Shut down on us.
W.com, that's
So
fine.
yeah, if you get that X network.
Yeah, so
type in that.
yeah, guys, to sign in, if you just type that in, it should bring you into the login page and then just enter in your details. Just give me a shout.
Yeah, of course, cheers. It shouldn't be quite as time sensitive as the last one when we talked about the Fed meeting, so it's not maybe quite as important to have Wi-Fi in case you want to trade or anything. But what's the sort of general feeling amongst the room for the markets at the moment? Do you think people positive about stock markets or quite negative and bearish?
Negative at the moment.
A bit negative. Yeah, one of the, well, a couple of the disasters I'll talk about do relate to stocks and also currencies and commodities, so it's kind of across the board. Has anyone managed to log in yet?
Oh yeah.
Yeah.
I've gone to the Polish XTB site.
It does that. I'm not sure why. So do that. but you can either go on translate or you can then just type in /en, it should bring you up. Okay, does anyone need this left up for any longer, or should we get going? We'll get going. Okay, so welcome to this Trading Club's Wealth Seminar. For anyone who doesn't know, my name's David. I'm the Chief Market Analyst here at XTB. And today I'll be running through 7 potential economic disasters we could see in 2019 and the impact that may have on the markets. Now, these aren't 7 things I necessarily think will happen. They're not a base case scenario, but you do get more big shocks in the market than a lot of people would have thought. Just last year, we had a couple big moves. Emerging markets, you could say, was a disaster. Certainly the move we had in the VIX around February time was huge. The year before, in 2017, there was a big move off the back of the French election when Le Pen didn't win and Macron won. I think if Le Pen had won, that was a potential disaster. So you sometimes see moves when it's shaping towards a disaster, and then if you have a sort of avoidance of that disaster, you can get a strong move the other way. 2016, we also had big moves in Brexit on the referendum, which you could call a disaster, and also the US election had that huge move from Trump. So before we go any further, as always, just a quick disclaimer and risk warning for our compliance team. For anyone who doesn't know, XTB are fully regulated by FCA. So what that means is what I say today shouldn't be taken as investment advice, it should be seen as market commentary, so please don't watch this, then jump out on the back of it, do a trade, and then come back to me and say, oh David, you told me this was going to happen. So I'll run through certain scenarios and things that could happen, but always take with a pinch of salt when someone tells you something about the markets, even if it's very respected analysts, you know, the top investment banks. This is 7 disasters for 2019. For instance, last year, Goldman Sachs did their 6 best trades for 2018, and I think by the time of mid-February, every single of the 6 trades had hit its stop loss. So there's no inside track or no secret really amongst the industry where people know what's going to happen, and you just have to look at what's happened lately with Brexit, which I'll come on to later, to see that a lot of people have differing opinions and no one can say for sure what's going to happen. So when you're trading, always I'd recommend using a stop loss and protect your downside, and also look for those nice trade setups. Even if you have a fundamental bias, something you think is going to happen, I wouldn't just enter the trade blindly and wait and hope it does happen. I'd always look for nice trading opportunities where the price action allows you to get in. So running through them all, first off, we'll start with a hard Brexit. Now this is looking a little bit less likely according to the market than it was a week or 2 ago, but I think it is still a possibility. Talk about trade wars, specifically the US and mainly their trade tensions with China and the increasing tariffs that we're seeing there, the impact that's having on stock markets both in China and the US, and also around the world. It is the world's 2 largest economies after all. Monetary tightening and the impact this could have in the euro area. One of the chief causes of the rally we've seen in stock markets in the last few years was very easy money, and now this is being reined back, the printers being turned off. Is this going to be negative for stocks? Italian exit, similar to Brexit obviously, but Italy leaving the EU, that could have potentially even larger implications for broader markets really, because it could well lead to the breakup of the EU. Let's not forget they're in the euro, the single monetary union. Political turmoil, this focuses on mainly politics within emerging markets, so talk a little bit about Argentina, Turkey, South Africa, Ukraine, Russia, and the things that could be happening there. Politics has become a bigger and bigger driver of markets, I believe, in recent years. When I first started following the markets back in 2011, there was some political movements around the euro crisis we had at the time, but it was a lot more really economically driven, I believe. With Brexit, with Trump as US president, you're getting greater and greater influence from politicians on moving the markets, for good or for bad. But either way, it's important to be aware of what's going on politically and the impact that could have. So we've seen some really big moves, none more so than Brexit, on the back of political developments. Second to last, we'll talk about Middle East conflict potentially, and Iranian sanctions from the US, and what this could do to the oil market. It could be very positive for the oil market. So even though you call it a disaster, it would actually be bullish for the oil market if this happens. This could be bad for other markets and other economies, but there is some suggestion that we could get a strong move higher in oil if there's an escalation in the tension between Iran and the US. Then finally, I'll talk about China and the property bust. Obviously, the last big recession that we saw in the Western world emanated out of 2007, 2008, subprime mortgages in the US, UK, and there is some suggestions that history is repeating itself in China. We could be set for a similar thing going on in the Far East. Before I go any further, this should take an hour, hour 15. If you have any questions, please feel free to raise them ongoing if it's about specific points. If it's a more sort of general question about a different disaster, maybe I don't mention, or a different market, there will be opportunity at the end to speak to me and I'll show you stuff on the platform. So please feel free to ask any questions whenever you like. So we've had a couple big developments this week on the Brexit front. As things stand, it's important, I think, to stress that the UK is still set on default to leave the EU by the 29th of March. That's when Article 50 deadline will expire, which will be 2 years from when it was triggered. Theresa May put forward her deal at the second time of asking after delaying the vote back in December. And despite two and a half years of negotiations, her deal was roundly rejected. It got nowhere near. It's the heaviest ever defeat by government in the House of Commons. She only had 202 supporters, 430 against, 230 vote margin of defeat, and due to the arithmetic needed in the House of Commons, I think you need 320 votes for something to pass. So she's still a long way short. I saw just earlier, BBC political editor was saying that they think there'll be the second vote on the 29th of January, which is when Theresa May is basically going to try and alter the deal slightly, whatever she can in the next 10 days or 2 weeks, and then put it back to the House of Commons. But it's looking very unlikely, to me at least, that this deal will pass, which means we're becoming into a situation where we either have a no-deal Brexit or we have an extension of the Article 50 deadline. I don't think there's enough time to work between now and March 29th to renegotiate a whole new package that's significantly different from what we've got on the offer at the moment with the EU, and then to get it ratified through Parliament. Despite all this, government still survived the motion of no confidence yesterday. They got 325 votes, so quite a narrow victory, but it's enough. If the government lost this, then it would have led to a general election. At the time being, it's hard to see a no confidence vote passing because I think the Tories have 316 MPs and there's 10 DUP in the coalition with them, and all of those are very unlikely to vote for another general election, so I think they believe that would open the door possibly to a Labour government or even a Labour-led coalition. So I think for now, Theresa May will stay. She obviously survived the vote of no confidence in her as party leader back in December, and the government for now seems set to stay in power. As the dust settles, it appears the markets are pricing in either an extension of Article 50. We've seen a positive reaction in the pound this week. There was reports just after Theresa May's deal was rejected, sources from the EU 27, so that's the other 27 members of the European Union, but they said they'll extend the Article 50 deadline to June. They may even need to extend it longer, but it seems like if Europe are willing, because they'd obviously have to agree to this extension, the UK can't just extend it on their own, then it may go on. And the possibility of maybe not even Brexit happening anymore, let's talk of second referendums growing in support. But it's important to remember that the default scenario is still a no-deal Brexit, and for that to change, the House of Commons would have to vote through basically and agree to an extension of Article 50 or even withdraw Article 50 altogether. Now this is a collection of several big investment banks and what they think will happen to cable as pound against the dollar in the event of different outcomes. To kind of summarise, the most positive would be a second referendum and Remain winning because that would preserve where we are at the moment. The most negative would be no deal. They've assigned probabilities on the right hand side. You can see this slide I took from Bloomberg at the start of the week, and they had a 15% probability the deal passed on the first occasion, which it hasn't, and they still believe there's a good chance it passes on the second time of asking. I don't personally believe that, but that's something to keep an eye on. Obviously, if this deal does pass through the House of Commons, then that is the withdrawal agreement, and that is what the basis of Brexit will be formed upon. I think for the time being, the way the market is, anything other than a no deal gets progressively more positive for the pound. So no deal is obviously the worst case scenario for the pound. I'd say the next worst really is probably the deal going through as it is, and then working up to a second referendum. A general election could be seen as positive for the pound because it basically could delay the process longer, and it could ultimately lead to the Brexit being reversed. Why these banks have said it would weaken the pound is they fear that if Jeremy Corbyn got in as a Labour-led majority, then some of his policies would be detrimental to the strength of the pound anyway. So it's not necessarily purely related to Brexit why they believe the pound would weaken if there's a general election. Now, this old and new from JP Morgan was before the deal was rejected and afterwards. You can see Brexit occurs on the deal, it's still their base case scenario, so they gave that 50% probability, they've now trimmed it to 45 after being rejected once. A disorderly no-deal Brexit they thought was 10, but they now go only 5%, so like I say, it's being priced out largely by the market, which means if it does happen, then you'll probably get a bigger negative reaction in the pound, because people are starting to assume that we're basically going to get an extension and move towards a soft Brexit. Second referendum, they say, is still 25%. General election, give a 15% chance. An extension of Article 50 to the second half of the year they had no chance for before the deal was rejected. Then I think there's a 10% chance of that. So it'd obviously be beyond June and could go on later into the year, possibly even beyond that.
Was it you who posted something saying that this referendum would take a year to organise?
Yeah, so there was basically leaked sources of official government papers that were circulated amongst MPs today to say if they wanted a second referendum, it would take a year to organise it.
That's probably my.
That's right. Yeah, so they said it would take a year to organise. I don't think it would take a year, but it would take longer than you'd think. They planned the first referendum for around 9 months, and it's quite a long, drawn-out process. There's lots of arguments about what the questions should be, and lots of legal steps that need to be done. So even if it was agreed upon we'd have another referendum tomorrow, it's highly unlikely you'd manage to be able to squeeze it through before that March 29th deadline. So this is the pound reaction, as I said, to May's deal being rejected. It was quite interesting to tell, really, what the market thought of this and what they're trying to price in reaction. You can see we got a strong sell-off. This is hourly candles in the 12-15 hours leading up to the deal being rejected, which was around 8:30 on Tuesday night. As you can see, we had a strong decline throughout the day. You just look at this hourly candle once the deal was rejected, very positive reaction, kind of sell the rumour, buy the news kind of reaction. And like I say, it seems the markets are really thinking defeat for May is actually meaning more chance for a soft Brexit or an extension rather than a no deal coming through. Which does mean if once more people start to fear an actual no deal will happen, there's a lot more potential for a shock in the pound because people are starting to position the other way and going long. Now, in terms of hard Brexit, what could happen? The Bank of England were asked to forecast their worst case scenarios. This isn't necessarily what they think will happen if there's a hard Brexit. It's if there's a hard Brexit and all the worst things from that transpire. So they believe we'd have an 8% loss of UK GDP. Interest rates would have to go up to 5.5% to try and counter the inflation. Could be a 30% drop in house prices, a 25% drop in the pound. Now, again, just to stress that, that's not the base case scenario. If there's a no deal, that's the worst case scenario. So these are extreme projections, but it's a kind of stress test the bank were doing to see how the economy would cope in the very worst case. If you're looking at individual stocks, the sectors that are most affected, probably chemicals and automotive. This is due to very close links between the UK and the EU on this. Johnson Matthey, jmath.uk on Xstation, could be particularly sensitive. In terms of automotive, you've probably seen news about Jaguar Land Rover laying off jobs and cutting back production. They're actually owned by Tata Motors, so they trade in Mumbai on the Mumbai Stock Exchange. So there's no car firms, really large car firms that trade on the FTSE. The biggest car firms that trade within Europe that would be affected would probably be the German car makers. The DAX is quite heavily weighted to German car makers. So you have Volkswagen, BMW, Daimler, for instance, all in the 30 stocks which make up the DAX, so they could be adversely impacted in how Brexit. It's easy to focus on the negative aspect for the UK, but it would obviously have negative impact on, say, European car makers who sell their cars into the UK. Now, just to look at the big picture, take a step back for a moment. This is a weekly chart of the pound US dollar going back to the 2016 referendum. What's interesting, worth pointing out, which is often overlooked, is the pound actually rallied in the week ahead of the referendum because traders were betting essentially that we would remain and that would be seen as pound positive. So you can see after opening the week around 142, we had a 700-800 pip move to the upside. So when you frame the drop in that context, it's not quite as severe as it looks, if you know what I mean. If we fell from 142 to 136, I think it ended that week, it's a 600 pip drop, but because it had rallied beforehand, when it dropped lower, the fall was much greater, around 1,400 pips. From that day, or from that week, I should say, down to the low, we saw January 2017, there was a 20% drop, almost exactly, roughly speaking, from 150 to 120. You can see we recovered a lot throughout the following year. Last year, we got almost back up right around these levels where we were before the start of the week of the Brexit vote, had a double top, and then we started to get a pullback here. Now this, I think, was in part US dollar strength as well as pound weakness. Remember, there is two parts to the pair, and it's impossible to say most times which one's contributing how much to the move. This was obviously very pound-led. But throughout here, a lot of this was dollar strength, but we fell back down just a couple of weeks ago, hit the lowest level in over a year, below 124. But you can see we had a hammer, and we are starting to recover. We've moved above 129 actually today, up to around 129.50. So things were looking a little bit more positive. In terms of that Bank of England worst case projection, 25% drop from current levels, taken from around 129, roughly speaking, would see a move down below parity to 96 to 97 cents to the pound. So that would be a really major shock. I don't think it's going to happen, but I would be wary at the moment. I think being long the pound seems to be the trade. It seems to be the path of least resistance going higher. But if you do start to get talk of the no deal becoming a realistic possibility again, people might start to get skittish pretty quickly, and we could see a swift move lower. On the other hand, if no deal is taken off the table, as Jeremy Corbyn's been pressing, then that obviously eliminates the worst case scenario, and things start to look a lot better for the pound, and it becomes, the range of scenarios then becomes, I suppose, sort of slightly positive to very positive, depending on the deal, all the way up to a second referendum maybe. Now, just after the vote that Theresa May lost, and we got that reaction positively in the pound, a couple of investment banks, Deutsche Bank and Nomura, both announced that they'd recommend going long the pound. Now, they prefer to play this through the euro pound rather than the pound US dollar. So short euro pound is obviously long the pound and short the euro. You can see it's quite a nice trade from a technical point of view as well. You can see we had this long period of consolidation for around 3 weeks. And once we pulled down below those 89.30, this was the day of the vote when we popped back above there. And we've continued lower. And as I took this picture just about an hour ago, we're just dropping below that 88 handle. 50-day SMA has acted as an all-right gauge, kind of identify the trend. Really, it's been range-bound for the last year. But you can see here we had a nice push up, whilst we're above the 50 SMA, below it. We were looking positive for this. This was when the pound was weakening. Now the pound is strengthening and we've fallen back down below there. And we could be getting moves down easily 0.87, 0.86 if this pound run continues. Now, it's not just Forex markets that are impacted by Brexit developments. Anyone who watched the referendum back in 2016 will remember that the pound fell very sharply, and so did the FTSE in the immediate reaction. But because the FTSE 100, which is UK 100 on XStation, the majority of the firm's revenues on that index are generated in non-pound terms, mainly US dollars. If you think of the mining companies, the oil companies, somewhere around 70–80% are generated in non-pound terms, which means as the pound falls, their earnings become higher in pound terms. So within about 2-3 days, we saw quite a strong bounce in the FTSE, whilst the pound remained under pressure. Within 3 or 4 days, the FTSE was back where it was the Brexit referendum day, and within 2-3 months, the FTSE was actually quite a lot higher. So you get this inverse relationship around Brexit events in particular, where if you see a strong move in the pound, you often get the opposite in the FTSE. As we've seen that recovery and that move higher in the last couple of days in the pound, you can see the FTSE's come back under pressure. Again, it's a 50-day simple moving average. I wouldn't trade specifically off the 50-day SMA, but what you're looking for is, are you the right side of the trend? If you're above it, you want to be going long. If you're below it, you want to be going short. There's periods where it doesn't work too well, like here, when you're chopping around in a range. You can see once we drop below it here, that's a nice sell signal. Here is a nice buy signal. Here was possibly a sell signal. You could look for the retest and rejections, retest, rejection, possibly another retest and rejection. It's starting to look a bit negative. Most ways you look at the FTSE, it's in a downtrend, and I think you really want to see the clean move back above this 6,950 sort of region before you start to think this downtrend's over and we're looking more positive going forward. Okay, so moving on to number 2, trade wars. There's been rising trade tensions from the US and China, and they obviously pose a very big threat to global growth as they are the world's 2 largest economies by some way. The impact at first was more keenly felt on China. The US, after all, imports a lot more from China than China imports from the US, and their stock market, which is CHN comp on XStation, fell into bear market territory within a couple of months of the tariffs being levied. That's a bear market which is defined as a 20% drop from peak to trough. US stocks did just dip into a bear market and ended their longest ever bull run on Christmas Eve, which was the longest time they've ever gone without a 20% correction. I'll show you some historical comparisons in a moment. Possibly due to this big sell-off that we saw in US stocks in the final quarter of last year, we saw a notable softening in the stance of the US towards China. Trump in particular is very keenly follows the stock market. Every time it hits an all-time high, he was basically tweeting and taking credit for it, saying it's a reflection of great economic policy, which unfortunately for him meant when it took a nosedive, he was also attaching his economic policy to the market reaction. According to reports of people who speak to him and are around him, he's very worried by the stock market drop, and because of that, he started to think about maybe softening his stance on China, delivering some good news on the trade front, which could boost stocks back. There have been positive comments of late. So the tariffs were first introduced around March, April last year, or they were first announced. I think they came into play around June. But they were only relatively small. They were due to be hiked up considerably on January the 1st, the start of this year, if they hadn't agreed new trade terms, which they hadn't. But this hike was postponed, given another 3 months, because after Xi and Trump met in Buenos Aires at the G20 meeting, they basically said they thought they could work towards it and could avoid higher tariffs, which would be better for everyone. If this does continue then, and you don't get an amicable solution, it's very easy to imagine that we wipe out the whole Trump bump, which is basically the rise we've seen since that 2016 election, and the S&P 500 and all US indices could fall considerably. Now this is top US trading partners. You can see China with $636 billion a year, the biggest. Canada and Mexico aren't actually too far behind, but obviously that's largely due to where they are geographically. And also, there was trade tensions between the US, Canada and Mexico last year, but they agreed a revised version of NAFTA, the USMCA, and now there's not really too much concern on the trade front between them. Whilst they are a big trading partner of the US, they're nowhere near economically as big or as important to the world GDP as China, and that's why the 2 largest economies in the world going head to head, basically taxing each other's imports and exports, is seen as a big laggard and a big weight in global growth. Relatively speaking, you can see Japan and Germany, the one just come after it much, much lower. Now at present, there's 25% tariffs on around 50 billion Chinese imports into the US, and 10% tariffs on a further 200 billion. Now they were talking about ramping that 200 billion up to 25% from the 1st of January, but like I said, they've postponed that until March. And Trump's also said before if this still doesn't yield the desired breakthrough in trade talks, he's willing to go another 250 billion at 25%, which would account for pretty much all of Chinese exports to the US. So you can see, whilst things are fairly bad at the moment, relatively speaking, there's a lot bigger impact this could have on Chinese exports. Now, talking about longest rallies in the S&P 500, I took this from the 7 Disasters report. If anyone's not read it, you can email me. I'll give you the email address at the end, or contact your account manager. We'll send it out to you. We should have already sent it out, I imagine. This slide was made in December, before Christmas Eve, so before the S&P did actually break into 20% correction territory, so it ended the bull market. And as you can see, it was the longest ever run without a 20% correction, 116 months, just shy of 10 years, just going over the previous one, which we had from October 2002 to October 2007. You can see also, compared to previous ones in the 90s, the 80s as well, it's far, far longer. And the worry is the longer the market goes without a correction, the same that an economy goes without a recession, when one does occur, it will be a bigger shock to everyone. Typically, it's seen by most economists, regular recessions or pullbacks in the markets every 4 or 5 years is actually quite healthy. It stops people being over exuberant, it checks the markets back to more realistic levels, and then they have a better base to grow from again. If you have a prolonged period of strong growth, as we've had here, in terms of the stock market since 2009 low, there is a lot of gains to hand back, so it's really sad. Yeah.
Sorry, on the last slide, the numbers didn't make sense, because there's a 5-year period from 2002 to 2007. So 5 years is 60 months?
Yeah, October 2002 to October 2007 should be 60, shouldn't it?
Roughly, yeah.
I think.
Sorry.
I think these are the wrong way around. This is 10 years, isn't it? Or just shy of 10 years, which is probably around 113 months.
Oh, I see.
10 is 120 months. You're right there. Yeah, it is wrong. So, but yeah, this 5 years is 60 months, isn't it? So that should be one of those. Yeah, that should be 60 months. I'll do all wrong. That's a good sport, sorry. But take my word for it, the last bull run up until December was the longest ever. We've introduced data which goes back further now onto X-Station. Some clients used to say, particularly with the pound US dollar fell to its lowest level, I think, since 1987, 1986, after the Brexit move. And people would say, oh, the chart only goes back to 2000. I'd like to have more data. So we've introduced going all the way back. See, this is the S&P 500 going back to 1970, when it traded at lowly 70 points. And you can see, whilst in percentage terms we have big rises here, especially the 80s and 90s, the size and move, especially in nominal terms, is much bigger than we've had in the last 10 years. And this is why some people are worried that after such a big run-up, there's a lot of scope to hand back some of those gains. The last financial crisis, for instance, from peak to trough, was a drop here of just less than 1,000 points, 10,000 points, it's normally equated to one decimal place. And you can see, in nominal terms, it's not much bigger than the actual decline we saw more recently.
Hello.
Hi,
Hi.
That's anyone who's traded US stocks in the last quarter of last year will have seen we had some huge swings. Boxing Day, I think, was the largest ever rally in points terms. And if you look in terms of points that the Dow was moving, or the S&P 500, I think 8 of the 10 biggest ever days with final quarter of last year. Obviously, that's because we're coming from a higher base, so in percentage terms, not the biggest. But when you're trading, points is normally what your exposure is, so it's quite a large move. So looking a little bit short time frame, it's a weekly chart. Going back to that low, we have March 2009, 666 was the upper low, the S&P 500. To the all-time high we saw in September, 29.47. You can take fib retracements from low to high. You can see, even though we've had what feels like a big pullback, and it is a big pullback, it's only 23.6% of the entire rally. So if we were to start to get 38.2. You can see that's 2075. That's nearly 600 points, 530 odd points below where we are at present. If you start, people who trade on fibs often even look for a 61.8, which is a full 1,000 or 10,000 the way you quote it below where we are at present. So if things do turn south, then there is a lot of scope for downside in these markets. Quite a simple way to identify the trend on a daily time frame is use a 200-day simple moving average. The way you look at it is simply which side the market is of the 200 SMA, that's the side you want to be on. When it's above it, you want to be long. When it goes below it, you can either go short or you can stop being long if you use this. This can be used in investing as well as not trading. You can see since 2010, the vast majority of the time we were above that 200 SMA as you'd expect in an uptrending market. What's worrying is what we've got now looks to me quite different to anything we've really had before. You can see there was dips below here. This period when we had concerns around China slowing down, which we come on to later in more detail, around 2015, 2016, we did drop there that 200 SMA. But you can see since then, on these occasions, this was Brexit when we had a big drop, this was the US election, even earlier at the start of 2018 when we had that big drop in early February, almost exactly it stopped at 200 SMA, and things were looking okay until we had this period of choppiness, which wasn't too worrying, but the most concerning thing for me is what happened next. We fell well below that. Not only are we below the 200 SMA, but you can see it's starting to roll over, and that's another way you can look at the trend, simply which way is the SMA pointing. You can see here, it's pointing higher, pointing higher, pointing higher. Period it doesn't, but the vast majority of the time it's pointing higher as you'd expect in an uptrend. So, focusing in again, a little bit shorter time frame. When I analyse markets, I normally start longer term. This is a bit of an extreme example, just show how far the stocks move. I wouldn't use monthly candles typically, but I think it's always good practice to start using longer time frames, then hone in on shorter time frames, try and find a more accurate entry. From the 2016 election, you can see the low overnight was 2030, and you can see we rallied all the way 29.47. This is the SMA, shown a little bit more closely. You can see how here it acted as support. We've had a 20% drop from there to there, and it would take a 22% drop from around 26.08. I think we're trading 26.20 when I just looked earlier before coming in here. It would take a further 22% drop to get back down to here. You can see this is quite a big push up higher from 2016, just under 2 years, to the 2018 high, about a 45% gain. It's a very strong gain in the stock market. So again, when the market's gone up so far, so fast, there is some scope for some sort of pullback. Now, whilst you can take fibs off the larger move from low to high, I thought it was a phone from me. So whilst you can take fibs from low to high, you can also, if you believe now the market's peaked and it's turned lower, you can take fibs from high to low, and then you're looking for a retracement back up to get short and look to trade down on the downside. So what I've taken here is a fib. I've drawn it from here, but I'm actually taking the point from here, 29.46, the high, taking it to that low, around 23.19. What you can see is we're currently coming into quite an interesting area. I took this chart just about an hour ago. I think around this area, 26.32, which is a 50% retracement, so half the way back up of that drop that we saw. If we do get any reversal signals here, it would be quite nice to look for a short position and see if we can get another push back towards those lows.
It wasn't here that when the interest rate was gone up.
Well, yeah, for anyone who came to the last event we did of this, I remember you came, which way we know, we had a Fed meeting where basically there were concerns that the Fed would still raise interest rates even though the market was dropping. Looking back on the day, it was this candle here, was the day of that Fed meeting, and anyone who was here will remember or watched it, the market was rallying quite strongly ahead of it. Because they were expecting a more comforting, dovish message from Chair Powell. When the chairman didn't deliver that, hiked and basically said, we're not going to ease back on our quantitative tightening, which is something else I'll go on to in a moment. You can see we've got this negative reaction. I think it was 25.28 was this low, which coincided with the lows from back here I had drawn on that day. And I'm glad you brought this up, because it's a nice example of when you have a big move on a central bank decision, not just a day, but for several days afterwards, you can see we dropped significantly below that, dropped over 200 points to the downside, which is a very big move for the market and not far off 10% further. We've since recovered, we've gone back above, it was 25.90, I think the high that day from the Fed, so we've gone back above there, but I think we are starting to find a little bit of resistance around here, so if we do see a reversal, then there is scope for another pull down lower. Now, one of the things I want to talk about just quickly in terms of how markets correct, people often think that markets drop very sharply and then turn around very quickly and go all the way back up. But if you have a large move, you normally get some sort of retest. It doesn't have to go all the way back down if it's a drop. You normally get a pullback somewhere towards that low. For instance, here, you can see we had this sharp drop, recovered very strongly, but we had to come down and basically prove that we couldn't take out this low before the market could recover again. See here, when we had a drop, attempted recovery, the low didn't hold, recovery, low held, recovery, couldn't break here, low kind of held. When that low gave way, that's when things turned really ugly. And I think from here, from a risk reward perspective, around these levels, it's more attractive to me to be looking for short positions with stop losses around 26.30, looking for a pullback somewhere towards here. This big rally here, I'll show you on the next slide. This big rally here, you still can't see it great, that was on Boxing Day. Huge rally to the upside, largest ever points gain for US stocks. Probably helped a bit by thin markets, there wasn't many people trading, so when it took off it really went. But I think even though we had this big rally and followed through, I'd expect, if you ask me what I think is most likely to happen, remember I don't know, so don't go out on a whim on this, and I expect that if the market does pull back down lower, we could easily see 24.50 even down here. Let's not forget, it's only really 3 weeks and we've raised, about 300 points, which is about 13%, so a very, very strong bounce. It's also worth pointing out the largest rallies you get in stock markets are often in bear markets and when the price is going lower. Some of the biggest updates we saw in 2008, 2009, where after a heavy period of selling, everyone wants to rush back in and get long, the shorts have to cover, and you get short, sharp, short covering rallies, but not always do they take hold. And I think we could get similar action to here, where we drop down, pull up, and then come down somewhere into here. If this low gives way, then obviously the outlook's looking pretty negative longer term. But as long as the low holds, I think we're looking a little bit more positive going forward, and especially if we get some positive breakthrough on this trade wars story. Okay, so third one, those two are the most in depth, so we won't be here all night, don't worry. Monetary tightening. So the rally that we've seen globally, I'm talking now in stock markets since the global financial crisis, 2008, has been driven in no small part by what economists call easy money. The Fed, European Central Bank and Bank of Japan all cut rates to record lows and embarked on quantitative easing, which is essentially printing money since 2008. This has made stocks relatively more attractive as investors search for extra yield. So in sort of traditional finance theory, the idea is if you're an investor, you have two options, either stocks or bonds, and the relative returns of each changes how relatively attractive they are. So if you look at it from the perspective of bonds, the less money you get from holding bonds, the more attractive it is to put your money in the stock market. 6 months LIBOR is seen as a sort of benchmark interest rate, which you could use to look for the Eurozone. The last 5 years, 6 month LIBOR has had an interest rate of minus 0.17% on average, which means there's absolutely no money to be had. You actually be losing money if you have basically bonds or you're investing in debt in the Eurozone. The previous 25 years as an average was 4.2%, and that's a lot more what I call sort of normal in terms of where the bond markets are. Now, dividend yields change a lot on different benchmarks, but if you look at a rough gauge, it's a dividend yield on a benchmark is normally somewhere between, let's say, 4 to 6%. So if you can get 0% or even slightly less than that holding bonds, and you can get 4 to 6% in stocks just on the dividends, let's forget about capital appreciation. Stocks are seen as a lot more positive. The problem with this is the Fed is now conducting quantitative tightening, so that's basically unwinding quantitative easing, letting money roll off their balance sheet. And the ECB ended their asset purchases, their quantitative easing program, just last month. So to put this in perspective, securities bought by central banks as part of QE asset purchase programs between 2009 and 2017, US 2.5 trillion US dollars, EU 2.6 trillion US dollars, Japan 3.8 trillion US dollars. These are huge, large-scale buying. What we've got at the moment forecasted, this isn't forecast by us, this is what the banks have told us and told the public at large. The US are reducing that by 0.6 trillion throughout this year. That's quantitative tightening. The EU, as I said, have stopped asset purchase, so they're flat. They shouldn't do anything, is what they've said. And the Bank of Japan will carry on, but at a greatly reduced rate. Now, why this is important is a lot of people think a lot of this money, which went into the financial system, was basically stuck into the stock market to try and gain extra yield and get some return. For instance, if you look at the size of the ECB QE program, 2.6 trillion, that is 70% of the value of MSCI EMU index, which is basically a broad index of European equities. So if you look at how much the ECB created in terms of money, that's 70% of the total value of European stock markets. So it's not hard to see how this can have quite a big impact on stock market values. Now this is a chart shown since 2012. The first QE programs did begin, I think 2008, maybe 2009 in the US, but the ECB were a bit later to come in on this. And what we saw was the US was going across full throttle. I think it was quantitative easing 3 in 2012, 2013. As they started to wind down, the ECB basically ramped up their asset purchases between them and the Bank of Japan, which was pretty constant. You can see we range between 50 to 150 billion monthly net asset purchases between the Fed, the ECB and Bank of Japan. Now what's worrying about this is you can see we've had this big drop off in the last couple of years and we're actually projected to tighten. If you remember, I think it was 0.6 trillion, the Fed are expected to tighten by, Bank of Japan were expected to do 0.25 trillion, so 350 billion of tightening. And if you believe that the markets went up because of quantitative easing, the same logic suggests that they should drop on quantitative tightening, which we're actually getting now. Now this is looking at the banks, going back to 2011. All throughout this period when the market was rallying, 2012, 2013, from the previous chart there was large-scale asset purchases going on. You can see now it's started to ease off and the markets have started to pull back. I think this is something which contributed into selling we saw at the end of last year, alongside with trade wars and other concerns. Now there's different ways you can value a market, so if it's over or undervalued. One of the most popular is the price-earnings ratio. If you think about it, if you take a given amount of earnings back in 2012, you'd expect that the price relative to that would be similar at some point in the future. You'd basically be paying the same amount for the same euro of earnings if it's the banks. So if we return to the PE ratio in 2012, you can see we have a drop to 9,500. Obviously, PE ratios will go higher if you're having more money coming into the market because people are willing to pay more for the same amount of earnings. Price sales ratio is a bit more conservative. You can see if we go back to a price sales ratio out from 2012, we'd have a drop down to 8,500. So significant downside, not huge by any means, but there is still some scope for moves lower. And as you can see here, I've got a rough level 10,270, which was a low that we saw around Christmas time. We've bounced off it, but we've not bounced quite as strongly as we have in the US. And Europe and the UK are still lagging a little bit in that coming out of it. And for these assumptions, these 9,500 of the PE ratio, 8,500 of the price sales, I've assumed 5% growth in earnings and sales in 2019, which is a fairly consistent standard estimate, I'd say. So we've already talked about Brexit, and the prospect of an Italian exit is something which could really be a disaster for the market. I was quite surprised when I read this. the number of Italians that would vote to stay in the EU is just 44%, which is the lowest of all 28 countries in the EU, including the UK. If you remember, the referendum was 52-48, so 48 voted to remain. The problem for this is that Italy has very large levels of debt at the moment. You can see in terms of their government debt, they have 2.2 million, more than France, more than Germany, but as a percentage of their GDP, their size of the economy is quite considerably higher. If we get a spike in bond yields and jump back to those levels we saw during the Euro crisis, which I'll show you in a moment, 2011, 2012, just when I first started trading actually, if we do get back up to those sort of levels, then it would cost an extra 65 billion euros for Italy to service their debt. So it gets very expensive then. During May 2011 to July 2012, we saw a 20% drop in the Euro-US dollar, which was during the last Euro crisis. You can see here, back from those highs, straight up around 150 Euro-US dollar, fell all the way down to 120. So if we had a 20% drop from our present, around 114, that would take us well below parity to around 0.92. So again, the last Eurozone crisis was coming from Greece really, concerns around Greece. Italy's a far bigger economy, it's far more closely linked, I'd say, to the overall health of the Eurozone. And the problem is if Italy were to seek an exit from the EU, then you could get others following not long after, Spain, Portugal, and any of those PIGS countries which struggled back around that time. Italy also have, I suppose you call it non-traditional government at the moment, with the Five-Star Party leading a coalition. And whilst they've said they don't want to come out of the EU, they're quite Eurosceptic, and they've been, particularly with their budget deficit, they've been pushing the EU rules basically. So turning to emerging markets, I'd say 2018 was a year of chaos for emerging markets. There's a diplomatic crisis in Turkey when they arrested the US pastor, I think he was called Andrew Brunson, on terrorist charges, and saw a huge drop in the lira. We also had President Erdogan influencing monetary policy. Now, people normally, most economists believe that if you have higher inflation, you need higher interest rates to counter that. Erdogan went contrary to popular opinion and believed higher interest rates actually caused higher inflation. So as inflation was getting higher, he was looking to cut interest rates and then very reluctant to raise them. So inflation was running out of hand, and we got a very strong move lower in the Turkish lira, 90% surge, US dollar Turkish lira, which hit all-time highs around August at the peak of that diplomatic crisis. There was election worries in Brazil. There was a 35% gain in US dollar Brazilian real. Brazilian real has actually recovered quite well recently. Bolsonaro's come in, and he's seen as a similar sort of candidate, if you want to make a comparison to possibly Donald Trump. Slightly pro-business, right of centre, and seen as quite positive for the economy, at least in the short term. So we've seen a good recovery in there. And Brazilian stocks, which is BRA Comp on X Station, have actually hit their highest levels in many years lately. Back in 2016, around the US election, everyone remember the moves we had, US dollar Mexican peso, 30% rally. And emerging markets are often less liquid and more volatile than traditional markets, which is a good or a bad thing, depending which side of the move you're on, I suppose. But there are certainly very good opportunities to make a lot of money in emerging markets, but you need to be wary if you are trading them, that they are more volatile. And also things like the spread between the bid and the ask, because they're less liquid, will be wider. You won't be getting as tight a spreads as you'd have in Euro-US dollar, for instance. So 5 countries loosely to talk about. First, we'll look at Turkey. What will go wrong there? Look at Ukraine. We don't offer Ukraine markets. We offer the Russia 50, which is a stock market, 50 largest companies in Russia. Argentina. It's unfortunate we don't offer the Argentine peso because there's been some huge moves in that last year. But due to its economic ties with Brazil and Chile, we see moves in Brazilian real and Chilean peso. South African rand, US dollar, we saw a nice move in that on the political front. and also closer to home, still an emerging market, is actually by some definitions moving out of emerging markets into a developed market, Poland, the Polish zloty and Wix. So I'll just run through charts of each. US dollar, Turkish lira, so monthly chart going back to 2003. I was speaking to one of our Italian sales guys earlier and showed him this chart, and he said it looks like a hockey stick. And I said, yeah, it does a bit. It's clearly an exponential rise that we had. See, back these times we were trading around 1.7, 1.8 lira per US dollar. This was August last year when the pasta crisis, and we had that huge diplomatic incident. Got a huge move to the upside, a rally, I think it was around 35%. I remember one single day, the market rallied 20%, which is one of the biggest moves you'll see in emerging market spaces. But since then, the market has pulled back down lower. You can see even these last two candles, whilst they are green, there's quite long wicks above, which is indicative of selling. Now, trading US dollar Turkish lira, one of the important considerations to have is there's a much higher interest rate in Turkey than there is in the US, which means swap points are impacted by that. If anyone doesn't know, swap point is basically your overnight financing charge. So when you use leverage, you need to pay or you receive swap points depending on which side of the trade you're in. And I personally was trading this on the short side a little bit around here, and luckily stopped trading it before this happened because you were getting very attractive swaps for holding shorts. What you're basically doing is putting the money in Turkish lira where you're getting 15–16% interest rates, and if you're leveraged, you obviously get that more in short term.
Is it still
borrowing in the US dollars, which was about 2%.
Is it still going on? Because they used to pay 25%.
Yeah, I mean, if you think about Argentina, we don't have it. I think Argentina went 60% in terms of interest rates. Turkey, this breakout here, which happened around April time, was when they were widely expected to raise. They were about 15, and Erdogan basically said, no, we're not raising rates. This will cause more inflation. The currency, the lira crashed, US dollar lira rallied. And then we had, a very weak, fragile market, and the kind of straw that broke the camel's back, if you will, was this pasta crisis, which was in, I think it was 8th, 9th of August. I'd just gone over to our branch in Poland at the time. I remember seeing 20% move in a day, which was huge. So if you are wanting to know about swap points, if you open a trade calculator on XStation, it will tell you before you enter the trade what the swap points will be, given or received. And it is an important consideration if you're trading over a bit longer term. If you're trading intraday, you don't pay any swap points, you don't receive any swap points. If you're holding 1 or 2 days, it doesn't make a big difference. But if you're looking to hold 20, 30 days maybe, then it is something to keep in mind. Russian stock market, you can see here, quite a nice chart, this one. Very clean, well-defined range from early April up until present. You can see around 1,030, 1,040, nice buying opportunities, nice selling opportunities around here. We are going back up towards the upper end of this range. Anywhere around here may be an attractive short from a risk-reward perspective, but ideally what I'd like to see from my perspective is if we get above 12.06 to get in a long position, have a stop loss relatively close behind, and look if we can run back up towards those 1340 levels. The Russian stock market, due to some of the largest companies on it being large oil producers, is quite sensitive to the price of oil. And anyone who traded oil will know we had quite a big sell-off in the oil price, particularly here, but we had quite a nice bounce to start this year. So if we do get oil going continually higher, and I'll talk about potential of oil going up as high as $100 a barrel later, then we could get back up before that, above that level, no problem. Sorry, it's just scheduled a update. Sorry, just 1 second.
I go back 4 days ago. I was working on that.
Yes, it popped up on the bottom right. Maybe I clicked on it and it disappeared.
Just both good and bad because then it gets you all in the time. The first last, I got to I got to
You couldn't rules.
Sorry?
You couldn't buy it. I mean, if you wanted to follow rules,
and then I kind of look forward to that.
We don't offer room because it's the reason.
in market, market.
Yeah, well, that's the reason they're quite, as markets are don't trade very well, same as Argentine peso. Yeah, at times there's very, very little liquidity in the market.
We wanted to buy, we didn't buy.
Yeah, that's why we don't offer it, and that's why we offer this, because it's a little bit more liquid and you can trade it. If you look at charts of the people when it trades, same as Argentine peso, they're very gappy, it'll have no action and it'll trade here. So it's very difficult to trade. Right, okay, so like I say, ideally a break above 12.06 would be quite nice, and you could maybe look for a push to the upside. Oh, sorry. Okay, now, as I was saying about Brazil, how the real strengthened on the back of Bolsonaro winning and taking power. It's a very nice setup here from a technical point of view, head and shoulders. And I think it's important whenever you're looking to trade off these fundamental events, you're following things that may happen. As I said right at the start, try and have some sort of technical setup and levels you're looking to actually enter off. This is a head and shoulders pattern. You can see shoulder, the head, second shoulder. The neckline's a little bit messy because we have this false break lower here. But for me, I'd take a neckline around 366.50. And the way you trade it is you basically wait for a break below the neckline. Some people may take the neckline here. Let's assume you've got 366.50. And if you break below there, you enter short with a stop loss above the daily candle, which has fallen to the downside. And then you target a symmetrical move from the neckline to the head, projected below the neckline. So this to this is the same distance as that to that. One of the reasons I like trading this sort of setup, one of the best reasons about trading this sort of setup is, by definition, it will always give you very nice risk-reward ratios because you're always looking for a big target, because you're not even just looking to trade this, you're looking for the whole head. And also, if you use last candle rule, as in if the price breaks below here on short and have a stop loss above there, your risk is fairly limited. Now, some people get disheartened trading head and shoulders patterns because they don't play out that regularly. It's different for different markets. Let's say they'll work 40, 50% of the time. But if it only works half the time and you make 8 times when you're right, what you lose when you're wrong, it's still a very profitable trading strategy. So I think this is one of the nicest charts at the moment. If we do break below there, to look for a short entry and target a large move down to 312. US dollar ZAR. The start of last year, we got a lot of weakness in South African rand around our own political problems there. You can see we had this push up. We had this kind of flush. So there's a flush lower in the rand, showing us higher in US dollar ZAR around this time, where we moved up to around 15. We did go back up, unlike in the Turkish lira, and break the highs, but we have been drifting back down. When you get these kind of capitulation moves, sometimes it's seen as a sort of sign that the market's gone a little bit too far. A bit like we saw in US stocks in those last few days before Christmas. It's kind of all out capitulation, there's nothing below it. It's dangerous to try and step in front and catch a falling knife, but once you do start to see signs of reversal, like here for instance would be a nice reversal signal, you can look to go short, or even here would be better. From the lows here, around 1150 to the highs of 1570, to pull back around this 50% fib, which is halfway obviously, and quite a nice sort of line in the sand. I think if we hold above here, if you look for more upside towards this 23.6, but if we do break below this low, then I'll expect to see further decline, 61.8, possibly even 78.6, or even all the way back down lower. You can use several models in terms of inflation and how strong the economies are to predict fair value of where markets should be. And a lot of emerging markets during the rout that we saw last year got very, very cheap on these relative valuation models. I wouldn't base trade solely off that, and I say always have a stop loss if you are trading like that, because you can get those big flushes lower where it will flush out to one side. But barring any further disasters, which is a big if, there is some scope definitely for ZAR to recover, and also Brazilian real and Turkish lira. So finally we look at Polish stocks, the week 20. The second half of last year didn't actually fare too badly compared to more developed and traditional markets. And we've got a similar sort of pattern to what we had in Russian stocks. There's really a year pretty much of range bound action. What I like about this is we're now testing this 2382 level, which was this high here, previously acted as support. Now we've broken below, we act as resistance there, possibly resistance again. And once more, if you do get a reversal in this sort of region, it's quite nice from a risk reward perspective to look for shorts and pull back even to the middle of the range, give you a very nice risk reward skew for a relatively tight stop loss above. So coming on to oil and potential conflicts in the Middle East. As I'm sure most people are aware, the Middle East is a very key area, region for oil, and any disruption you have there does threaten to cut off the supply of oil, and that would obviously boost the price. In terms of oil and the supply and the demand side, they obviously both play a part in driving the price, but in the near term, and especially when you have sharp moves, it's very often supply driven rather than demand. Even if the economy slows quickly, like we saw, say, 2008, it does take some time for oil demand to drop significantly, whereas supply moves can happen almost overnight. Last October, oil prices hit their highest level in 4 years. Brent oil, which is oil on X station, was just below $87 a barrel on fears of supply disruption caused by these US sanctions on Iran. At the very last moment, the US basically granted waivers on the Iranian sanctions related to crude oil. They kept the sanctions on for other areas. And what this meant was we got a sharp reversal and a big drop lower in oil. It fell 40% from its high, which I think was made at the start of October, to the low in December. So 40% is obviously a huge move in the market. However, these sanctions were put on to basically act as a deterrent from Iran pursuing a nuclear program, creating nuclear weapons. And if Iran do resist and do continue going down this path, then there may be greater conflict and tension with the US going forward, possibly even US military action, you don't know, and possibly a large supply shock in that part of the world. Now, the Strait of Hormuz is a small strip just off Iran in the sea, where about a third of the world's seaborne oil travels through. And it's such a narrow strip that you could actually, if you wanted to, you could blockade this simply by sinking 2 tankers side by side, and you wouldn't be able to get any ships past because it's not deep enough. You could go over the top of them. So logistically, it's not that hard to block it if Iran chose to, and this would cut a third of seaborne oil, a fifth of global oil, almost overnight. It could take out the market, which would be very, very positive for the oil price. I remember when I was trading oil back in 2012, there was some tensions between the US and Iran, and there was news on the wires that US fighter jets were seen flying over the Strait of Hormuz towards Iran, and the price of oil jumped around $5–6 in about 30 minutes. So it can be very, very sharp and aggressive moves if there is a realistic prospect that this will happen. In terms of Iranian exports, Iran have had quite a few problems infrastructure-wise in pumping as much as they can. They actually have capabilities to supply 4 million barrels a day. You can see in April when they're about their highest level in recent years, so about 2.5 million. By October, when these sanctions came in, they'd fallen down to 1.5 million anyway. If the sanctions came in, then that could cut that down even further. Note that the US doesn't buy much Iranian oil, but the issue would be if the US said to other countries, you can't buy it as well, we've got the sanction on it, we don't want you to buy it, and then take measures against other countries for them to also implement the sanctions. So oil's one of my favourite markets to trade. I think it's very clean technically. Technical analysis was first really used successfully in commodities markets in the 70s and 80s. And you can see here just quite simple 8-period EMA, the blue line, 21-period EMA, the yellow line. If you get a bullish cross, then you want to be long. If you get a bearish cross, you want to be short. Bullish cross, you probably want to be long. I think here we could be getting a nice inverse head and shoulders possibly developing, which would target a large move higher. Obviously, for this to happen, we need to break above these highs. I've took it at 62.50 as a neckline. There is some subjectivity here. You could look at these wicks, say you want it at 63.75. But if we do get up above that level, then it becomes a lot more positive. We could hit 74. And obviously, if there's some big disruption from around much higher.
8 and 21?
8 and 21, both exponential moving averages, EMAs. Having said that, like I was saying earlier about US stocks, when you have a big move, you often don't get the market turning around right by itself, and it wouldn't be too surprising if we did get some pullback into this sort of region, possibly a lower right shoulder, which technically is not as nice, but it could still happen. If you look at textbook custom charting patterns, they look very pretty, but in reality, you rarely have an exact textbook setup in the market. So it's a sort of head and shoulders or a sort of pennant or a sort of trend line. So you can see here, it's worth watching, I think, closely in the coming days, see how we react. Today we actually went above 61 and we're moving back up towards this level. And if we can get above there, I think there is scope for quite a strong move. You can see we bounced from 50 around the time stocks bottomed, and we very quickly did $12, which 1,200 ticks is a very big move in any market. So last but not least, property in China. I was quite surprised when I saw these stats. 22% of homes in China at present are vacant, which is almost double the vacancy rate you see in the US and Japan. And that equates to 50 million empty apartments. These are taken from the Seven Disasters report. If you look at Chinese growth, which has been very, very good for the vast majority of this century, averaging 13.3% GDP per year. A large portion of that, actually, if you look into the components of the growth, is what they call fixed urban investments, which is obviously infrastructure spending and spending on housing, often coming out of public purse. If you were to take that out, the economy would have only been growing at 6%. So a large portion of that has gone into the housing market. If you look at construction as a share of GDP, in China it's almost a quarter, US 5%, Germany 5%. So it's a lot bigger market there relative to the economy. And if you think what happened with the house price shock in the US about just over 10 years ago, when construction was only 5% of the economy, there is implications where it could be far worse in China, particularly if you have similar situations with banks, credit default swaps, CDOs, etc. In terms of affordability, I know London's expensive. The average house in London is 20 times higher, or 20 times, I should say, the average earnings. New York's 12 times, Melbourne, Australia's 8 times, Johannesburg only 3 times. In Beijing, Shanghai and Hong Kong it's 45 times. So you've got a very elevated house market compared to what people are earning, which means there's a lot of probably overvalued houses. When I was speaking to someone about this slide earlier, they said, how come house prices are so high still if there's all these vacant houses? And I think that's because it's not a completely free market. People are probably holding houses back because they know if they flood the market with all these apartments at once, they drive the price down. So if you're a developer or a government body which owns these houses or apartments, you'll probably be trying to drip them in to the market and keep the price high. You don't want to flood the market and send it lower. But if prices do start to turn lower, there's a big build-up of supply which can quickly come online and send the market down. Now, the main market I've chosen in terms of trading to do with this is copper. 50% of global copper demand and 90% of the demand growth that we've seen in copper this decade has come from China. 60% of the Chinese demand comes from their electrical grid and also construction. Copper is seen by many people as a quite easy proxy on world growth. If the economy is doing well around the world, people are building things, copper is one of the main building tools in this. and we've seen quite a drop. I'll show you a chart of copper in a moment. Some people call it Dr. Copper, and if Dr. Copper is ill, is the argument, then it bodes badly for other markets. We saw copper actually fall off last year around the time Chinese stocks did, not without coincidence, but that was a big warning sign, I think, for US stocks, which obviously carried on sort of unperturbed up until the end of the third quarter before finally realising the slowdown we're having elsewhere. Fears of a hard landing in China aren't anything new. 2015, in August, we had a big drop in Western markets and in Shanghai on the back of the fears of a hard landing. It happened again around the turn of the year. But they keep kind of emerging and then receding and then emerging and receding. What people are hoping is you'll have a soft landing, which means Chinese GDP growth, which is currently around 6%. I think everyone believes that's really unsustainable long term, but they're hoping that will come down very gradually in line with developed Western economies. So again, 5%, 4.5%, 4%, something like this. People are worried it will drop very quickly from say 6% to say 1%. And then that would obviously be a hard landing and a bigger shock. As well as copper, there's other markets you can trade around this. Chinese stocks, CHN Comp on XTB, and anti-Canadian currency, so Australian dollar, New Zealand dollar. That's because the Australian and New Zealand economies are quite closely linked to China. So in terms of copper, this is a weekly chart. Again, big picture, looking back 2010, so far this decade. The 200 simple moving average on the weekly has done quite a good job of defining the trend. You can see uptrend for here, big downtrend for several years when we're below it. This was one of the fears around Chinese hard landing the first happening. We had this recovery in 2016. Things were looking quite good. 2017, there was strong growth US, Eurozone, China was performing quite well. But you can see here, around May, June time, not long after those tariffs came in, on China, and we saw the drop in Chinese stocks. We got this big decline in copper. We've consolidated really, but we are threatening to break back below this 200 weekly SMA. If we break back below there, then there's significant scope for further declines going down there. This is a shorter chart again with fib retracement, just to give us some perspective, levels to look for. From this low we had around 1516 to the high. We've pulled back around half of it. Thank you. Yes, you can. And we pulled back to around half of it, 5,800. I think this is an interesting level. If I'm looking to trade this, I'm looking at these lows here. If we pull down into it, will we have buying pressure and wicks again, or will we turn lower and fall down? 61.8 is quite a nice level to look at. 5,446, which may not sound that far away, but it's around 10%, so it's still scope for quite a nice move if you're looking to trade it. Chinese stocks fell sharply last year into a bear market, as I said earlier. Technically, they're not, I don't find the nicest to trade. What you can see really after peaking early on in the year, late January, we had this large drop, never really recovered, period of consolidation, another drop. And we're getting a kind of expanding range, drifting lower, with lower highs and lower lows. Lately, we've seen a bounce, which coincided with the recovery seen in Europe and the US. There's been some measures from the Chinese central bank, where they're embarking on their own versions of QE to actually try and prop up the market there a little bit. And they've also cut their reserves, required reserves ratio, RRR, by 1%. But still, they're not embarking on very large-scale, strong monetary policies like we saw Fed, ECB, and Bank of Japan do. So, sort of levels here, I'll be looking around 10,800, 10,900. Then on the downside, this low here, 9,775. If we lose that, then there is scope for significant drops. I think this is the last slide. New Zealand dollar CAD. Again, like I said, for the dollar, Brazilian real, it's nice when you get head and shoulders set up because you have nice risk rewards. Canadian dollar is also sensitive to oil. So if we do get continued gains in oil, you could see downside in this pair, Canadian dollar rallying. And a little bit nicer, cleaner possible neckline, 0.8915. Not far from where we are, 25, 30 pips. This is a sort of trade which could trigger in the next couple of days. If we do break below there, like I said, I'll be looking to go short, but stop above the daily candle, and then targeting a move down to 0.8575, which is just over 300 pips, 340 pips to the downside.
So that one is highly probable, isn't it? Do you think? Well, if it breaks that,
I wouldn't say
if it breaks the neckline, actually.
if it breaks a neckline, I think it's a nice setup because simply, let's say we end today here. If we break below 89.50, you could have a stop loss at 89.50. So you're short 89.10, you're risking 40 pips. You're looking to make, what was I just saying, 340. So your risk reward, if you're risking 40 and you're looking to make 340, that's very nice. Risk reward is 8.5 to 1, isn't it? So that's a lot of the other ones. When you're looking at weekly charts, you're probably still a bit away from areas of action in the coming days, but this is something I'm watching closely. And kind of hope it does happen. It doesn't happen late tomorrow, because then you've got it just for a weekend. You need to decide if you want to hold over Saturday and Sunday. So those are all the slides. If anyone has any questions or wants to copy the slides, whatever, that's my email address, david.cheatham@xtb.com. Does anyone have any questions, anything I went through there, or want me to go back over anything?
Could we have a look at this pound dollar, please?
Yeah, sure. I think did you miss it when you came? It's the one I started with.
Probably the best one there.
So yeah, basically, as you probably know, Theresa May's deal was voted down, but they survived the vote of no confidence. Short term, it's been positive for the pound. You can see we've got the strong bounce here. There's still a chance of hard Brexit, although I think the markets are starting to think that's less likely. You can see JP Morgan assigned the chance for disorderly no deal Brexit at just 5%. This was a collection of banks which gave a 15% probability, but this was before the vote was rejected. So I think that's probably seen as lower now by the markets. I had 129.30 as a level I've been talking about on the WhatsApp group for the last few days, which would break higher. I'm not sure it's actually trading now, but it was 129.60 when I was coming in here. And I think it's looking quite positive in the sort of short term. I was also saying euro pound. You can see here, Deutsche Bank and Nomura were basically saying they're bullish the pound after recent events because they don't think we'll have a no-deal Brexit, but they prefer to play it by a short euro pound rather than a long pound US dollar. I might be able to get. See if we can get live market. Yeah, you can see 129.84 down the bottom there. For some reason, the internet's really slow on this bit. Yeah, I think in the short term it's quite positive for the pound because the general expectation is there won't be a no-deal Brexit.
Yeah.
But if there are significant steps towards it in the coming days, then I think we could get a sharp move lower. So the way I see it playing out is either a sort of slow, steady grind higher, as you get slightly positive news that it's going to be a soft Brexit. If you do get something negative, there'll probably be a quick move to the downside.
We take a look at some stocks like JP Morgan, Harley Davidson.
Yeah, we can come on to that in a moment. Banks have been reporting so far this week, so there's been some big moves. Bank of America, saw me to the upside, Goldman Sachs, JP Morgan sold off. Yeah, I can't really, it's missing the side of it, but as you can probably see, this here was 129.30, which I thought was quite a decent possible resistance or level to trade from. Once you break above that, it's quite nice to be long above 129.30. possibly see a pullback into here might be a nice buy. But just be wary if you're going longer. There's obviously huge bangers at the moment, and you can get quite swift moves there downside. So obviously, I'd recommend having a relatively tight stop loss.
Okay, there's a good chance of Brexit not happen.
Yeah, I think the general feeling is that's got more likely. And you've got to remember, when you're trading the markets, what you're basically doing is trading everyone else's expectations. So it's people with a lot more money than you, a lot more size than you, who are playing out what they think will happen. And even if you think a no-deal Brexit's going to happen, it might not be wise to get short now, because it could easily be squeezed 400, 500 pips higher and then drop very sharply, like we saw before the Brexit referendum. So that's why I always say, if you're trading it, look for the price action and look for entry signals and places where you can enter nicely, rather than holding too strong fundamental bias and trying to fight a market that's being pushed the wrong way against you. And then if you are ultimately right, you'll make money anyway. I think
If Brexit doesn't happen, it's good for the pound.
I think so. The general feeling is, in the near term, the less disruption, so the less change, is more positive, and the least change would be no Brexit. There is some case you could make longer term for certain aspects of Brexit to maybe be equally positive for the pound, or even slightly more. But I think in the near term,
If the disaster happened, they're expecting 25% drop.
yeah,
Also, they
that's what the
can
Bank of England said.
expecting the move up 25% or not?
I don't think it's symmetrical risk like that. I'd say the upside is not as severe as the downside. So that survey of banks said they thought 135 if there was no Brexit. So that would be, 6% above where we are, 7% above where we are. I think there's scope for more than that going forward. It could easily go to 140, 145, something like that. But I don't think you'd have as sharp a move or as quickly. It could take 3 months, could take 6 months.
We had 160 3 years ago.
Sorry?
We had 160 3 years ago.
Yeah, it was trading 2 10 years ago. It can, and that's why it's always crazy when people are like, oh, it's so low, it can't go any lower, it's so high, it can't go any higher. And after Brexit, it fell to its lowest level since 1987, I think. So, it was many years, 30 years.
When people break their account.
Yeah, well, exactly. And that's why don't fight it if it's going that way. It's a lot easier to try and trade with the trend in the short term. Even if you don't believe it, don't try and fight the market. If it's clearly going against you, there's no point trying to take it. Wait for reversal signs, wait for entry signals when you can get back in that way.
Did you see the S&P 500?
Yeah. Sorry, I was going to try and get to the banks. This might be a bit painful because the internet's very slow. So if you trade US indices like the S&P 500, I'd always recommend looking at other markets as well, even if you're not trading them. So the NASDAQ 100, which is US 100 on here, or the Dow Jones, which is the US 30, the companies in those are both in the US 500. So what happens with them can also impact other markets. You can see now, actually, we just had a strong move higher in the S&P 500. There may be some news on.
What happened just now? What? You said we've had a strong move higher, right?
Yeah, just in the last few minutes, there's been a bit of a push higher.
Oh, right, yeah.
Obviously not seen any news. And if you look at US dollar, there's US dollar weakness as well.
What time frame was that on your top left?
Hourly,
Hourly as well.
but it's just there in the last 10 minutes.
What's that as well?
Just change that.
There's probably some news out. Possibly something that's dovish from the Fed, maybe. You can see US dollar weakness. Too much. There's another thing, I didn't mention in disasters, but there's the US government shutdown.
Thank you.
Cool, thank you very much. There's a US government shutdown going on at the moment. There could be some breakthrough on that, but I'm not sure. I've not obviously seen the news. But it's quite a nice move to the upside. And you can see it's also the banks as well, and even the FTSE. So there's something quite positive about it. Yeah, as I was saying, if you're trading one of these markets, it's always handy to keep an eye on the other ones, because if you're seeing here, for instance, US 500 is breaking out, US 30 is breaking out, you can see US 100, the Nasdaq still not taking out yesterday's highs. So if this is rallying strongly, this is rallying strongly. If this breaks 6735, it could be a nice trade to jump on the back of it as the other markets are rallying. They obviously don't move in perfect sync, but they often do move similarly. So if you see one market up, nearly always the other markets will be up if it's over 0.5%.
Are there any other sort of markets to look at when you're looking at the S&P 500?
So the way I line it up, US 100, US 30, US 2000, that's small cap US stocks that can often lead, and also the VIX, which is Forex. Cheers.
Can I have your email again? Your email again.
My email, yeah, sure. Cheers, thank you.
Cheers.
This is my husband.
Cheers, thank you. Yeah, I think we'll call it a day there, really. If anyone wants to ask any questions, please feel free to come up. Cheers, thanks. So that's the volatility index. It's called the VIX. Most places, it's basically to do with the S&P 500. It's the volatility on S&P 500. But what you can get sometimes is this is downside volatility. So if the VIX spikes, you often see the S&P 500 sell. Yeah, they don't always move exactly together. Sometimes you can see, like then it looked like the S&P 500 went first and the VIX went afterwards. Like the other day, the S&P 500 was near its daily highs, VIX was near its daily lows. VIX broke out and it was about 5-10 minutes, then the S&P 500 broke out. So they're correlated, but the correlations can change, and it's not like a hard and fast rule, so obviously everyone will do it. But it just gives you a little bit different perspective of what's going on. Cheers. 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 Thank you very much. Cheers. If you could drop me an email to that, cheers. Thanks. Yeah, if you can send me an email to that, I can reply to it. It's probably the easiest. I was also told to ask you as well if anyone could, if you enjoyed tonight, please go on Trustpilot and leave a positive review. We're trying to boost our Trustpilot. So if you didn't enjoy it, then please don't leave a negative one. Yeah, yes, I can send over this nice thing. Cheers, thank you.
That take profit isn't too much. Cheers for today. Cheers.
Cheers.
Cheers. Thank you very much. Thank you very much.
Cheers, thanks.
Drop your email.
Yeah, if you've got me an email, I can send it across. There's also, have you seen the 7 disasters report? There's a whole report, so it's linked to that. But I can send it to you as well.
Thank you.
Cheers, thank you.
Thank you very much.
Find out what this means. Yeah, cheers, thanks.
Thank you.
Okay.
The beginners and the training.
Yeah.
Would be the best advice to start there.
So, if you're a beginner, I'd say first off, try and keep things as simple as possible. So that probably means choosing one market to trade, get to know that market well, try using a demo account and practicing different strategies, so find out what kind of suits you. There's not one right way to trade. If you're not only, you can have lots of different ways to be successful trading. You can also have lots of ways to be bad at trading. So you need to find something that's in keeping with you. Some people like to trade very short term, short time frames, in and out, take money off the table. Other people prefer a little bit more longer term, what we call a swing approach, where you hold trades, 2-3 days, possibly even a week or so. It's a nice trade. So I'd work on that, try and define how you want to trade. Before you go into a trade, always calculate your risk, always use a stop loss. It's very important to have a stop loss. Too often people are like, oh, I think that's a really good trade, I want to jump on the back, I'm going to make loads of money. But they forget if they're wrong, and traders are often wrong. Even if you're profitable, you'll often be wrong. What you need to do is make sure you protect that downside so they don't lose too badly on the downside. Because if you lose all your account, then you can't trade and you can't take advantage of good opportunities going forward. So yeah, try and keep it quite simple. Have clear entry levels. You know, a clear signal. I want to buy when it gets here, I want to sell when it gets there. Know what you want to do. You can write it down in advance if that keeps you to it. The worst you can do is just kind of open a chart and on a whim just say, I'll buy that, I'll sell that, with no stop loss. If you have clear entry signals, your stop loss should be whatever negates your entry signals. So say, for instance, you've got S&P 500 then, 26 was yesterday's high. Say you think that's possible resistance. If the market goes to 26, 22, you want to sell, you're looking to sell off that, you want to stop loss above that. If you get 26, 26, that's no longer resistance. Too often people get in a trade for one reason, start to go away from them, and then they try and justify other reasons for being in the trade, and then they keep moving the stop loss and end up losing more than they should. So yeah, try and be specific what you want, try and keep it simple really. There's so many different technical analysis tools you use. Sometimes everyone works brilliantly, none of them will always work perfectly. You're always going to get false signals. Know what you're looking for. You're looking for a trend trade and a breakout. You're looking to play a range. And yeah, just look longer term. Look for sort of, rather than looking, you know, at one massive trade which will make lots of money, but to be consistently profitable. You know, have a target for the week. If I hit this for the week, then I'm pleased. You can have a weekly stop loss target. You know, if you lose a certain amount, trading, and then look to have, you know, winning days. If you get winning days, you can start to get winning weeks. If you put together runs of winning weeks, you're not going to go 20 weeks in a row winning, but if 20 weeks you're winning 14, 15 times, you're only losing 4 or 5, wins a big losses, you'll slowly start to make money, build your account, and eventually to grow.
I'm trading New Zealand dollar with Canadian dollar,
Oh,
and
nice.
you showed, yeah, you showed the slide.
Yes.
So what you think will break that support?
But say, I'll get this started against the previous one. The problem, too often people, I think, when they're looking to trade, they think what you're trying to do is predict the market, and analysts are the worst for it, because analysts will say X, Y, Z reason this should be traded here. Really, as a trader, I think what you're looking to do is you're looking for asymmetric risk rewards. You're looking for a chance when you get it, make decent profit, and you're not having to risk money for that. So that's why I like having charges, and that's why if we break here, I'd quite like to be sure. I don't know it's going to go here. I might think there's reasons it will go there, but that's not really important. The important thing is to realise an opportunity when you can have a clear entry signal, decent profit target, and yeah.
Yeah,
And like that, this trade will take maybe months to happen.
Well, exactly. I mean,
Had in
from
mind
here
that
to here is 20 candles, 20 days.
20 days.
Yeah, so obviously if you're short
Can
term
be in
trader,
one day, but can
yeah, exactly.
yeah,
And you can take the other way, you know, this is support as a macro. And if it comes here and you get a real bullish candle, you could say, well, it's not going to break lower, I'll buy the stop lower. What's nice about this is when you have clear support or resistance, you can trade it either way. And when it's very close to it, it's not worth you trying to guess and say, I think this is going to drop, I think this is going to stay. Let the market shade it.
but head and shoulders is much higher probability to break like this.
Yeah, I think another thing with it as well is it's come down once.
This is
Let's
Head
come
and
from here.
Shoulders.
Yeah, this is a very nice one. An inverse or reverse, yeah. And you see that would have played out, you'd have had to hold it for a while. But the point is, with Head and Shoulders, I was saying, you often get 5, 6, 7 times profit for what you're risking. So you only need to be right
Make a lot of money.
1 in 5 to break even. If you're right 2, 3 out of 5, you start to make lots of money.
I was a little bit aggressive in my trading. I entered on this position after
it break this accumulation
Yeah.
phase,
Yeah.
and
I mean, like I said, there's lots of ways to trade. There's not a right or wrong way. A temptation always in head and shoulders is to try and get in a bit early and try and call the second shoulder, because if you're short here and it goes down to here, you're already in profit, and if it drops through there, you can then move your stop down to guarantee profit, and you get even a big profit that goes in. Another thing you can do on that is you can scale into positions. So, say for instance you're willing to risk £500 per trade, you can enter here and only risk 250, so half what you normally would. And then when it comes down here, if it breaks there, then you can put on the second half. So you have an average price halfway between, but you've got the second entry there. So you don't always need to be all in or all out in the market, if you know what I mean. You can half your position size if you're not so sure. There's nothing wrong with scaling back and then half, even a third. You can get a third, a third, a third. And the same with taking profit. If you're in here, the market drops, let's say, all the way to here, just above your target and bounces, you might think, I'm not going to be a real stickler for that extra 50 pips. I'll take off half. Then I know I'm guaranteed to make money on the trade. If the second half hits, great. If it goes all the way back, at least I've took some money. So in terms of risk management, scaling in and out positions can work quite nicely.
yeah, we'll see.
Thank you very much. Cheers, thank you. Cheers, thank you.
Bye-bye.
Yeah, you too. Yeah, of course. You just, you've got my email?
Yeah.
Or I can go maybe.
That's fine.
Yeah, it's easiest if you just drop an email, so I can just reply and attach it.
Alright, what are some of the sort of key things related to, say, like US and the UK, do you think? From your
So at the
analysis?
minute, in terms of this Brexit, it's obviously a big one,
Yeah.
and what happens there. US, I'd say there's two things really. I didn't touch so much on the Fed, or the Federal policy. If they continue hiking rates, then it's negative stocks, but if they don't, then I think we could recover. And the trade tensions with China as well. And that was one of the disasters. The second one, I think, if there's not a de-escalation in that, then I think it's hard to see big rallies in US stocks or China if they carry on at this rate.
Okay.
Yeah. The Fed, since they hiked, if you remember the dot plot last time I was talking, I think they were projecting 2 hikes for 2019.
Okay.
Now the current market expectations are for no hikes in 2019,
Right, okay.
and well, 15% chance for a hike, also a 15% chance for a cut. So very quickly the market's got quite dovish what it expects from the Fed.
Okay.
And so that should be positive for stocks and negative for the US dollar, but the problem with that is if the market all of a sudden starts to think, oh, we might get 1 hike, we might get 2 hikes, and it could be negative for stocks.
Okay. Oh, thank you very much.
Good,
Thank
thanks.
you very much.
Good to see you.
Thank you.
I'm on the Inter group.
The what?
Inter group.
Oh, right,
And do you wish to have a Forex one?
yeah. Yeah, I don't really know much about it, to be honest. What is
The
it?
group, WhatsApp group,
Right.
the analysis. But I'm just receiving indices.
Oh, you're on our
Yeah,
Forex one? Yeah, so we have 2. We have Forex and indices.
if you can.
Do you want to be on the Forex one as well?
Yes, please.
Yeah, sure. Who's your account manager?
Read.
Yeah, if you tell Reed, he can add
Can
add
you
you in.
call him for me?
Yeah, of course. I think he's good.
Yeah.
Alright. Cool, cheers.
How did it go?
Yeah, pretty decent actually.
What drink the bastard?
And knock it over.
Mucky bastard.
Yeah, there you go, one on the floor.
No, I'm joking.
Yeah, decent turnout. Right.
How do you pause your recording? Is it done?
Oh yeah, I should probably stop it. I don't know how to do it.
1 second.
Is Eric still there?
Give me 1 second.
What is that noise it does that? It sounds like a writing thing.
What on this?
Can you hear that? Like it does
Yeah,
it
it's
all
all
day. It does it all day. Like when it's quiet, yeah, you can hear it.
I've never noticed it before, but yeah.
Get to pause the stream.
Yeah.
Oh yeah, what's your